but we heard it from a couple groups that said our CapEx assumptions were a little light, and then they started to then focus more on deals that had a little more protection against potential CapEx exposure. I don't know if you guys have felt the same way or experienced that, George. It wasn't you. It wasn't
one of us.
I mean, if you're buying a well-leased medical outpatient building, I mean, there's probably two ways you could lose. One, you misunderwrote market rents on renewals, and the other is CapEx and misrepresenting what the CapEx needs would be for any given building.
But yeah, I mean, this is as much a story about NOI as it is CapEx. I think this chart, right? Like commercial office has probably been receding, and they've been probably buying occupancy over the last sort of decade.
Yeah, you're right. It's all relative.
You know, life science is extremely capital intensive, just given the fit outs there. So that's probably the story around that. And then, you know, I was sort of looking at this curious, why is senior housing relative to apartment lower? And I think that's the NOI story, maybe potentially even over the last sort of the growth period has a play in that as well. So, but specific to medical, I mean, I think you have to be really careful, especially with this trend in sort of outpatient. There are functionally obsolete assets out there. You know, the majority of the product is owned by owner users, and then, you know, what's left after that is very fragmented, and there's a lot of older vintage, sort of what we would call ant farm type investing assets, which we tend to stay away from because they're, you know, the TI and the LC and the churn within that is really capital intensive. So, you know, we try and focus more on newer vintage, you know, purpose-built, diversity of service lines within the building that, you know, are a little bit more resilient over the long term as the space continues to move into an outpatient setting.
Yeah, the churn, I was going to pick up on that too. Like that's a big part of the divergence between commercial office and MOB, right? Where you underwrite, what, like 85% renewal probability on MOB, and they renew 90 or 95% of the times.
The
commercial
other thing
office is like 60% you underwrite, something like that. So
the other thing that this could be capturing is, you know, 2008 is kind of the bottom of that inflection point in terms of when we went vertical in inflation. And, you know, most of what we do from a development standpoint or just from a product type standpoint tends to be master leased and, you know, fully occupied and, you know, net in nature, right? So there is no below the line, which is, you know, influencing the chart.
Yep.
Correct.
Let's see what's next.
Yeah, let's see. I
think this is the last one. So yeah, so this just brings it all back to, you know, why we're having the conversation here. Like all these things we're talking about drive this trend, which is the increasing share of alternatives into Odyssey funds, so core funds on the NPI, growing from about 5.5% just a few years ago to 13.5%. Medical, small share of that, but growing, and probably with more runway to grow beyond that based on what we've been talking about.
Yeah, so being that it's a pie graph, it is presented in a binary, or call it zero-sum framework, right? While the numbers may increase or decrease the percentage, and you can see how much industrial has grown to take some of the pie pieces away from the other asset types, while we've also grown in medical as well. Mm-hmm. Does anybody have any questions on, there are a couple more slides. Michael doesn't know that I threw a couple in. But let's take a halftime break if we have any other questions on anything that we've gone over thus far. Because a lot of this obviously is for you guys for content-wise, questions that you may have. I know I've been in the audience once and have itching questions and can't get to them at the end.
So, I don't know if the microphone's around.
Make this interactive.
Like it.
We should put a spotlight on you next time when you're doing it. It's like at the Grammys or some singers coming through the audience.
So, you know, organizations like Revista have benefited from a lot of move towards alternatives. But I think, you know, it's always been my supposition that organizations like, you know, if you look at the original research organizations that tried to prop up commercial real estate, like MREIF, for instance, you know, they're the ones that define the kind of core food groups, you know, office, retail, industrial. And like, investors were left with like, that's it, that's all that exists out there. And then somehow apartments got folded in and then multifamily. And I think MREIF is just now starting to track some of the alternatives. I mean, I don't think, when you think about it, Welltower is the most valuable real estate company in the entire world. I mean, like or publicly traded at least. And yet they only own alternative real estate. I think that's crazy. It's like, why isn't this stuff considered core like it should be,
Big question. I think they're starting to get religion, right? Like you alluded to it. It was a couple of years ago, I think it was, and I don't know all the details. I know enough to be dangerous, but they created the expanded NPI, right? They changed the classification system, and George might know more too about like what's allowed for you to be able to call yourself an Odyssey core fund, right? There used to be like caps on certain sectors, just to be able to have parity across funds. They've changed that to give you a lot more leeway to get into alternatives. But like to your point, still it is pretty limited coverage. So like in these charts where you're looking at MOB, where you can break it out more and see it says the expanded NPI, it's still a pretty small sample size. We should probably put that as a caveat on here, that I think it's only like, I don't know, like 800 properties or something like that are made up, in the index for MOB behind those return numbers. And so still kind of like in its infancy in terms of being tracked by like a MREIF.
And a lot of the sources that track capital raise and equity, they still lump medical and healthcare, medical into office. It's hard. Sometimes you have to go through a little statistician triangulation to find the leftover, removing everything else, and then say, okay, that's medical, because we've accounted for office and we've accounted for these other, but they're a little slow. And to your question, I'm wondering more if it's, as Michael outlined, some of the requirements, but just the verbiage itself, it probably will stay long-term within an alternative classification just because it's not those core retail, office, and some sort of living component, because not that the returns or the amount of capital deployed into it or the transaction volume could increase substantially, but they may still classify it as an alternative just because of the utilization category, if that makes any type sense. Michael, click.
Yeah, you had a couple, right?
So this is to David's point. As we look at overall returns, we've got appreciation on there as well. So where we saw some depreciation in values, at the same time we saw cash flows continue to stay steady, even through the COVID downturn. We've got some touching on senior living and assisted, or senior housing and assisted living. So David, I didn't want to take some of the wind out of your sail earlier, but knowing that we had this on the back of the deck, speaking to your point. So appreciation returns have started to stabilize back through, but we didn't lose any of that cash flow during that time. I mean, I've used this stat for a while. I remember COVID, at least from our collections, we were at 94%. And there was like a 2% habitual even prior to COVID, so we performed extremely well. Any additional thoughts or comments in this?
I mean, I think.
No, go.
Yeah, I think this is why you've seen, transaction volume a little muted, right, in the space over the last couple of years. It's fundamentally the assets are performing, which is fantastic. You're getting your income return. But the reality is that, the long duration leases, it trades more bond-like. It's more susceptible to some of these yield curves. So
Super rate sensitive sector, yeah.
So, no one's selling low, right? From an appreciation perspective.
Yep.
But, hopefully, back half of this year, soft landing, if you will, if we're still landing.
It also speaks to the fact that more core plus value add light style equity is really what's appropriate for the sector. And I say that, like, I couldn't tell you how many times we have conversations with prospective equity partners, and they're like, we love the asset class fundamentally, we want to get in, but we need, 18 to 22% net returns on our money. And for all the reasons that it is an recession-resistant asset class, kind of puts a ceiling, absent, market externalities that would drive rates extremely low, puts a ceiling on where your total return is going to be.
All right, last one, Michael. So overall activity, as it relates to those alternatives, Mike, as you were asking about, and we continue to see the improvement. I mean, just word of mouth and conversations that we've had, alternatives are becoming obviously at the forefront of allocations in capital. So we've seen an increase of 26% of alternatives in the Q4 of last year, from 21 over the past 5. So George, touch on this really quick. I mean, just in your opinion, if you were fighting for $1 within your shop to allocate to healthcare outside, assuming everything is a fixed, finite amount, are you seeing it easier now or harder to argue for deployment into medical versus some of the other alternatives?
It's a complicated question. I mean, we have various costs of capital, so I'd say it's case by case. Within a few of those buckets, I mean, I think, the growth story within senior and our access, I think, to some of those partnerships is really compelling, and it's where we're spending a lot of time. From a durability of income perspective and a current income perspective and more, a core like wrapper, there's a lot of, the moment in time pricing, going back to your last chart, it's really attractive in medical, where, stuff that's historically was trading with in the 4 cap range is now, for the same credit and quality is in the 5 cap range. That 100 basis point expansion is a lot of income in the context of a long duration fund. So that's compelling. So it's case by case, but not to turn this into a senior living conference, but the opportunity set in that sector right now with the right alignment is really, really compelling.
You can mark to market rents on an annual basis in seniors, right? It's a little bit different of a story. Introduces risk as well, but that's what I think when you're jockeying for position and call it pipeline, right? Like that's, I think, what you're dealing with.
Yeah, well, seniors I'm not a seniors expert either, but I think you can get seniors at pretty attractive yields too right now compared to like where they were trading pre-pandemic, and that NOI growth profile is just so much more robust than an MOB, so it's going to win out.
Yeah, it's compressing, it's changing, it's compressing, but again, we don't even view, in some instances, don't view those as stabilized even in an occupied building, given some of the run rate growth from a revenue perspective, and so.
I'll lead the witness, and this can be to anybody. Is there a hurdle based on the size of our assets as compared to some of the other asset types? I mean, we are relatively small on a deal-by-deal, single asset basis. So when you've got institutional capital looking to put money into the market as quickly and as large as they can, once they've got a green light on that type of strategy. Are you guys fighting against that? I mean,
yes.
Yeah.
It's a challenge for sure.
It's always been that way.
It's just like that.
Bigger always tends to be better for most LPs, and having to educate folks that deal size here is much smaller, can be programmatic. To use a baseball analogy, I mean, you hit 4 singles, you're scoring a run, right? So, actually probably 2 singles, but
nobody
anyway.
hits singles anymore.
Anyway, there's nothing wrong with putting out $5 to $7 million equity checks in a chunk on a programmatic basis and getting 6 deals at that at that size out of the ground in a year. But showing people that there's pipeline and program there is a conversation.
Mm-hmm. I think it's important too to lean into that as a barrier to entry and a strategy piece. So I mean, I agree with what David was saying. It's a challenge to scale in the sector meaningfully and responsibly, but once you do and you can formulate these portfolios, historically that scale on exits garnered a premium, which is where you start to see some outsized return opportunities. So, and we could talk about portfolios, that's a different conversation. Using that, I think, to your advantage, structurally is an important strategy piece within the sector historically.
So there's a demand, there's a supply component of that. And how does that compare with respect to new development and ground new starts now versus, let's say, 12 months ago, and then let's go back 5 years?
Yeah, well, obviously 5 years ago, it was a lot more activity.
Yeah, we always have to consider
We all remember 21 and things. It was a wonderful year. We had a great portfolio sale that year and things. It's interesting, from Ryan Company's perspective, we're actually anticipating going forward year over year, higher number of development starts in healthcare than we are in industrial in some of our regions.
That's interesting.
Which is interesting because I think we do see this opportunity to do smaller, faster turnover deals and also repeat work. And part of when I look at this, it's interesting because we define medical as MOB, and we just consistently say that. And I think the message is that we're doing a lot more alternatives within this alternative class, right? And that we're doing so many more specialty asset classes. How many of us are talking about IRFs? I'm doing 4 IRF deals right now, personally, alone. And 2 years ago, no one wanted to touch them. And so I just think it's going to be interesting to see how we even then start kind of understanding and fragmenting the MOB or healthcare subclass. I've got a behavioral health facility going too. Again, a few years ago, we weren't doing any of that. I think ultimately, because of those alternative asset classes in medical are becoming more driven and more opportunity-based, a lot of that's private equity-based, so they're willing to move fast. They're able to be incredibly efficient, similar to some of the ASCs, in that they can operate much, much more effectively than some of the post-acute or hospital health systems. I think from that perspective, that's why we're doubling down. We're seeing more activity going forward in the next few years. I think 26 will continue to be kind of a transition year. 25, it was hard to be a developer in 25. We survived, right? But again, I think we're leaning into those alternatives, and it'll be interesting just to see kind of the story of how those trade in the next coming years and what that makes of your certain percentage of portfolios as well.
How does that pipeline on new starts versus renovations or even adaptive reuse, not that, I mean, how do those ratios compare now versus the past?
Yeah, I mean, obviously, the barrier to entry of new development is the high cost of rents, and I think ultimately, health systems, if there's an alternative office or existing MOB, they're going to go for it, right? Because they're going to see that difference of the previous slide that they had, $40 rent versus $25 rent. But it's interesting because I think as ultimately those costs start to change and there's ultimately less and less opportunities of those renovations, then people will do new development. From our perspective though, I mean, as a company, we do third-party design and construction, and interesting fact as well, healthcare design is actually our highest grossing activity right now. So there's a ton of work in design and renovation and expansion projects. We have a huge hospital expansion project we're doing right now, for example, because most acute hospitals and patient hospitals are needing to grow as well. So I think ultimately the story is new development is still going to be forecasted as we're hoping to be continuing to be high, but we need to continue to capture the renovation and value add work as well.
David, you can speak to some of that too.
We are, these days, I think, more focused on acquisition than development. But part of that is just by virtue of where construction costs have gone to and underlying rents, and, development has largely become, just a built-to-suit product right now. Yields have compressed, significantly as a result, and it's just forced us to look elsewhere, based on, where our capital needs to be. You're ultimately left with, the newest best product in development, which is, a great outcome there, but, it's definitely a challenging environment right now.
What risks are you guys most worried about as we come into 26? Michael, you were on a roll. I wasn't going to disrupt you on that, but you've had 3 or 4 business days, take out a day for travel, and yesterday with the new announced Fed chair nominee, has anything in approach changed in your forecasts and or projections with the naming of Warsh? We knew there was going to be a replacement, but
No, I don't think so. I think Warsh is a credible choice, right? I think he's a veteran of the Fed. I think you can see in the way that the market reacted that he's someone that's probably going to be able to build credibility among his colleagues, right, and have the respect of the markets, and is maybe less likely to kowtow to the White House and the questions of Fed independence that have come up over the past year. Take that into conjunction with the way reading the tea leaves and the way like the Supreme Court case seems to be going over the attempted removal of Lisa Cook from the Fed, right? So seemingly the outlook is for a more stable policy environment from the central bank. And it's funny because historically was pretty hawkish, right? When he was a governor before, and most of his public comments have been more hawkish and variety, but he's kind of pivoted over the past few years and been more critical of Fed policy and more of an advocate for cutting rates. How much of that is really a true turnaround in view? How much of that is trying to curry favor with the administration to try to get the job? It's hard to say. I think the bias is more toward the former, that he would be supportive of cutting rates further in the year. But again, you have to remember that he will be the chairman of the Fed, but it's just one vote on it too, right? There's 12 people who vote, and would have to build consensus to get that. And that's not a foregone conclusion at this point. The other thing too is that, of course, reminded that they are controlling the short end of the curve, not the long end of the curve too, and that is also going to be impacted by how investors view the U.S. and treasuries, right? And the outlook for some other policies that might bring back expanded deficits, bring inflation back. So, will they cut again a couple more times this year? Yeah, if I were a betting man, sure. Is the 10-year treasury going to be that much lower when we're on the stage next year? Probably not. I think we're kind of recalibrating into this new equilibrium of rates in that low 4s range right now.
Mm-hmm.
Any catalyst that you may, not to predict that they would happen, but maybe this is better for George or for David as it relates to acquisitions. If the 10-year were to get to, let's say, 4 or tick under, does that change the pressure on the throttle for acquisitions? Is there something else out there that's a catalyst that increases or even decreases, either direction?
I think you'd have to see a major movement in rates. I mean, certainly below. I mean, I think the 10-year's sitting around like 4.3 right now. I mean, you'd have to push well below 4%. I think to
seems like there's
see a
logical
meaningful
barrier.
Yeah, meaningful move in cap rates. And one of Mike's colleagues told me years ago when this, when we were starting to see, softness, in the economy, survive to 25. John Clement. Yeah, survive to 25. He recoined Sam Zell's, term. And I think John's right in that regard. This kind of the new normal now. We're sitting in that sandbox where the 10 years been around 4%. There's no real reason for it to, make a material move up or down, either way, minus dramatic recession or depression or something along those lines. I think we're kind of in the new normal, and if you have capital to deploy and get on with it.
Agreed. I mean, ultimately, I think investors are getting more comfortable with a lower return. That's what, in order to get deals done and new development, we're all just having to get more comfortable with lower spreads. Unfortunately, the days of very high spreads are over, and so we enjoyed those gravy days while we could, and we're just going to continue to be aggressive. And medical is a safe haven, as we know, a very stable asset class, so we need it.
We touched on it, but I've always, over the past, 9 months, has the big beautiful bill been a topic of conversation and projected impact into some of the performance of your systems, your clients on development opportunities? What internally have they been saying, or how are your each respective firms approaching that? No change, a bit of a change,
Definitely a change.
Oh, yeah.
and can you elaborate?
So we have always focused on payer mix in, any of our buildings, but, that's become, a lot more of a focus just in terms of, what percentage of your payers are, Medicaid-based. If you're looking at, that's for, where your building happens to be and what that, overall patient population is. We have some buildings in California that have a very high Medi-Cal population, and, those assets are, going to, those systems are, they might not feel it over the next 24 months, but certainly 36 months from now, they're going to have to make some changes. And, we're thoughtful in that approach as it relates to, where their rents are going to be, on expiration and, rent coverage ratios in that regard. Also focused on, certain facilities that have and operators that have a higher correlation to regulatory risk, right? So, whether it's inpatient rehab or PACE facilities or ASCs, it could be anything, but just understanding that payer environment is critical.
Are those hands off now?
Not necessarily so. We're still very bullish on PACE, for example.
Okay.
But, just understanding the nuances of where potential cuts can come and what that would do to your tenancy is critical.
Yeah. It's just a daily conversation with me and the CFOs and CEOs and strategy officers. The impact of, we all saw the value
Of the systems.
of the systems, of the big beautiful bill and the changes. We all saw the value that was wiped out in the market last week or the week before when CMS announced that relatively flat Medicaid, Medicare rate increases this year. It's just, the reality is that all of our tenants and especially our health systems can no longer provide every service to everyone, everywhere. And so I'm having so many more conversations about where is the highest prioritization of ROI relative to their overall service area. We're helping with shutting down facilities. We're having large conversations about where to put their dollar and when. I think so much of it is also like we just don't know when the tide is. Is there going to be yet another policy change? There's kind of like what's next going to hit. But I said in Minneapolis, Hennepin Healthcare is anticipating a $1.7 billion loss over the next 10 years. Billion with a B. It's just immense numbers. And so ultimately, we have to figure out alternative opportunities in order to still get growth done. So we're prioritizing, obviously, payer mix. We're encouraging them to chase after the service lines that they can, encouraging them to partner with independent physician groups that can truly own certain markets and referral networks for health systems. And then one thing that I'm exploring with health systems that I don't think we encourage enough is public subsidy. I'm having large conversations with cities right now. What kind of cost offsets can they offer these health systems for their medical office buildings? Can the city...
On the real estate level.
On the real estate level. Because ultimately, a cost decrease is still a potential net benefit to getting the deal done. And so can the city put in the ponding? Can the city help pay for the parking? Can we... All of those kinds of things. TIF is not necessarily an opportunity, but there's other incentives that can come to medical that we're having to have conversations because construction costs are not going down. The interest rate impact is going to be negligible. We've already lowered our spread returns, and they need space, and the vacancies are at an all-time low. It's just we're having to figure out other ways to do this.
Gina, I think in a more optimistic tone, and what kind of gets underreported is this repeal of the inpatient-only list that CMS recently did end of last year, and effectively that's taking 100, 200 codes, Medicare codes, that traditionally had to be performed in an inpatient setting, and repealing that over a 3-year period. That's going to have huge tailwinds into the lower cost outpatient setting. So I think you got to sort of talk about the two things combined. And, granted, that's just Medicare, but typically as CMS goes, the commercial payers go. So I think it'll be interesting to see how that plays out over the next 3 years to maybe counterbalance some of the cost pressures that they're facing, or capped cost pressures. Yeah.
And the potential for site neutral reform too, right?
Yeah.
Yep.
Which, another tailwind for MOB. And what I tell people internally and investors too is that as these pressures continue to come on the providers, that MOB will just continue to be part of the solution to it too, right? This is it's kind of old news at this point, right? Reimbursement pressures has always been a constant, and that's part of the reason why medical office performed as well as it has that we've been talking about, right? It's that's where they go to deliver care in a more cost-efficient manner. So I see that as just more of a tailwind to the sector too.
Depending on the system, they'll then need to, focus more within the four walls of their acute care setting, and they'll be more dependent on third-party capital, which could lead to additional opportunities.
What I worry more about now is just whether this kind of noise would kind of cast a pall over the sector and the capital markets, and the investor trends we talked about, people being interested in MOB, will that pull back a little bit if people hear these headlines and say well, hang on a second, we're an investor in single-family rentals, for example, and you saw how Trump came out and said he's going to ban institutions from owning single-family homes for rent, and we're still waiting to see how that actually materializes. I think it's really just playing politics at this point, but something like that, if that could just kind of pull the punch bowl away a little bit from MOB sector and cause investors to have some pause.
Is anyone taking a different approach and underwrite to academic medical centers as opposed to not, through just based on their exposure to R&D and government subsidized grants or gifted grants, anything of the sort?
I mean, it's an interesting question. I think you have to take a really close look at the credit viability of the institution or the site like you would any hospital campus, right? And it's top down, it's bottom up as well. How's the hospital performing? How's the overall ecosystem performing? Who's your obligor? That all, it's a regular credit underwrite, but it's
some of it though is, if you look at it in a historical view, may not be necessarily indicative of what it may be on the go forward. You could try to extrapolate on, all right, well, how much revenue is grant provided? How much of this is a loss leader for other service lines within this academic medical center, which may be at the core of their kind of vision, right, of delivery of care?
I mean, it's case by case. A lot of these universities, the health system is separate and apart from the academic.
Sure, we've seen more and more of that.
Body, which
right.
is typically it receives the lion's share of the NIH funding, if you will. So it's case by case. But yeah, it's definitely something I think was for a long time in the space taken for granted, right? The quality of these academic research hospitals, and now you just got to underwrite it as you would any other tenancy.
Yeah.
Location.
I mean, I think ultimately as a result of this too, you're going to see more M&A activity in health systems, and that's going to fundamentally change some of the demographics, the ability for them to act, just where and what services they're going to be providing. It's going to have huge effects on independent partnerships or not, whether they're closed systems that are being acquired or not. And I think academic healthcare facilities are going to be looking for those stronger systems and potentially partner with them. And so we're just going to see more cross-regionalized, I think, larger health systems as a result. Sure. And ultimately, though, I mean, though we all are nervous about healthcare and health system credit, and the performance of them. I think we all understand the enormity of the Stewart situation and all of that. Ultimately, though, we're underwriting the population demographics in the market. You know, I mean, the need for care, the services, the overall population. I mean, that's what we're truly underwriting. I think ultimately, rural care and those kinds of things are going to be so greater affected than obviously some of the core assets are more of the metros and things.
And a lot of the academics tend to own their real estate, right? So to the extent they're feeling balance sheet pressures, they can sell and lease back, you know, and there's
Which
no.
we're seeing.
Yep.
Any questions? What did we not touch on? What did you guys have a burning desire for someone on the panel to answer? It's none. Or you guys are just afraid to ask? Appreciate it. Thanks for everyone having us. Thank you all.
Thanks, Gina.